Let's take to our seats, please. So we can begin.
My friends are coming.
You have faith. You have faith. All right, maybe let's get the register going whilst we settle down. Okay, all right, awesome stuff. So to kickstart, I want us to quickly do a short quiz. Does everyone have a piece of paper? That's it. Okay. All right. It's fine. I was going to share the answers, and then that was going to be an ice task. But it's okay. You'll see it when I've uploaded it. It's fine. So today we are starting with learning unit 4. Okay. Today we are starting with learning unit 4, and maybe let me get this. Yes. Okay, so here you can see some of the outcomes. We're not going to finish with this today. Describe and apply the fundamental principles of financial management. Determine break-even point of a business organization. Calculate the present value and future value of amounts. Analyze and interpret financial statements of a business organization. Understand the financial planning process. Manage the current assets of a business. Evaluate investment decisions. Find financing for a business. This is quite interesting because I did not imagine that business management would be as comprehensive as they have been in this textbook from a finance perspective. Okay, so I think we've already just gone over this, so we won't look at those there. But to kickstart, they say the financial function and financial management is concerned with the flow of funds. Okay, now you've got the acquisition of funds, which is a fancy way of just saying financing. All right, to start a business, most businesses, there is some level of financing that is required. Okay, often the owners will put their own money up in order to start the business, but if you do actually have access to financing, some people will actually go and get the money from a bank or get the money from a financial institution that funds startup enterprises. Okay, maybe you have an investor who believes in the idea and obviously just wants a share of your company, and as such they're able to fund the company. Okay, but the first thing when it comes to the flow of funds is obviously we need to acquire some level of funds just so that we can cover business expenses. Then you've got the application of funds for the acquisition of assets. Okay. Now we know assets are are things that we invest in order to get future economic benefit. Okay, so obviously we need things like, for example, printers, vehicles, delivery vans, and all that kind of stuff in order to facilitate our process. Okay, so again, the application of funds to buy assets is something that obviously takes place. All right, then as financial managers, you would then obviously be managing how much we are actually going to put towards the acquisition of assets. Then finally, the third point there they have is the administration of and reporting on financial managers, financial matters. So there, you're obviously looking at obviously bookkeeping in a nutshell. All right. And they were obviously keeping record of all the transactions that have happened. So whenever somebody buys stuff, or whenever we buy stuff, all right, when people owe us money, or when we owe money, and that's what that is all about. So in a nutshell, that is what financial management is concerned with. All right. Now, that's just looking at it from a overview perspective. Now, getting into the nuts and bolts, the activities that are obviously performed are financial analysis, financial reporting. There's obviously planning that needs to take place in order to ensure that we have adequately dealt with all of the 3 points we just highlighted. And then there's obviously also the control. Okay, we need to manage our expenditure as a business. Okay, and evaluate whether that was good or bad financial management. All right. Yes. Then we can go on from this slide. Right. Then here they're just giving you a nice overview perspective of where financial management actually finds itself in the business environment. So there you can see the relationship between financial management, other functional management areas, related disciplines, and the environment. So one of the key things that we have to be mindful of in relation to all the different management spheres that we have discussed and are going to discuss, none of them exist in isolation. All right? None of them exist in isolation. They all lean on each other for different reasons. Okay? So here you can see the different factors that come into play. The form of the enterprise, financial institutions, and markets, basically the people who will be providing funding or who have access to funding. An easy example of that is obviously your banks, the stock market. If we are so lucky to obviously do an IPO of our company, when you register shares of your company on the stock market and do an IPO, that whenever somebody buys shares into your company, that is financing for your business. Okay. Then incentive measures, those are things also we need to manage. Bonuses, salaries, and all that kind of stuff. Then obviously tax, all right, and we can go on and on. And then they're just highlighting the tasks that we highlighted on the previous slide. Okay. And all of these activities that we engage in is for the purposes of achieving the business's objectives. Okay. And that you'll only get from the strategic management that obviously the board and your executives have shared with the business. All right. So again, it's just showing that these things do not, financial management does not operate in isolation. You can see the other functional management areas. So general management, influencers, supply chain management, because obviously they need to buy goods, then you've got marketing. We need to obviously purchase or pay for any marketing initiatives or programs. Public relations, all right, and then obviously human resource. We need to take care of our people, pay their salaries, and the like. Likewise, we also need to give budgets to these respective management areas. Right. So, concepts in financial management. All right. So we're all familiar with the statement of financial position. Okay. In other words, your balance sheet. Okay. And Here they're just highlighting, we know that the key aspects that are reflected on our balance sheet is that of assets and liabilities, okay? And you'll see there, they're basically saying assets is everything that the business owns, all the possessions of the business, okay? And for the most part, that is true. And we know we have non-current and current liabilities, assets. But remember again, I think I may have shared this in a previous lecture for business management. If not, it's fine. At the end of the day, you don't have to own the asset for it to be an asset of the business. It doesn't need to be your possession, is what I'm saying. Okay? And two examples of that is, for instance, whenever you go to an engine garage and you purchase airtime, okay? They don't own that airtime, but they're just functioning as an intermediary for Vodacom, Telcom, or whoever. It's the same thing if I'm somebody who works with Herbalife. I don't own any of those products, but it's an asset to my business because I can sell it to whoever gives me the money for the product. Does that make sense? So just be mindful of that. I know a lot of textbooks, even your accounting textbook, will tell you that these are the possessions, and on a very surface level, they are right. But if we really get into the nuts and bolts, you don't have to own the assets. Okay. If you also, another nice example is Airbnb. Not everybody who is managing properties on Airbnb owns the property. Does that make sense? Okay, cool. Right. Then liabilities. Likewise, we know your balance sheet obviously contains liabilities, and liabilities, as you guys know, these are financial commitments that we are obligated to. Okay, we've obviously got long-term liabilities, all right, and we've got short-term liabilities. Okay, so I don't think we need to dwell much on that section of the work. Then capital. Okay. Again, this is money that has been provided by way of the owners, all right, or the shareholders of the business, okay? Now, I think very important, I think they do a good job here of explaining what fixed capital is. And fixed capital is the capital that's been invested in assets. So things like a delivery van, maybe a factory purchased by one of the owners or donated to the business by way of one of the owners. And then working capital, all right? So these are your current assets, all right? Or money that we have in order to purchase your trading inventory and stock, isn't it? Okay? So here they also just said accrued power of disposal over products and services used by a business to generate monetary return or profit. That's the whole objective of capital. We plug money or assets into the business because we believe in the business activities and we're saying we are going to get a return. We're going to get some moolah as a result of this business endeavor, right? Otherwise, would we invest any money into a business that we are not going to yield returns from? We wouldn't, okay? So profit is always the reward for taking on that risk. Income, okay? Is there anyone here who doesn't know what income is? Anyone doesn't know what income is? I see no hand. All right. This is obviously the money that we get from either making a sale, providing a service, obtaining commission for work done, and the list is endless, okay? There's multiple ways that we can obviously generate income, all right? But the whole focus of whatever we're doing within the business is to generate as much income as we possibly can, all right? Costs, very simply, these are the expenses that we incur whilst conducting business, whilst trying to fulfill our business activities. Okay? So, I mean, your textbook goes a long way in obviously providing you guys with the fundamentals of financial management. Okay? And I think what's even more important is establishing the different types of costs. Okay? I know you guys know what fixed costs and variable costs might be, but do we know what direct costs are? What indirect costs are? Or overhead expenses? Anybody want to attempt any of those? Yes, sir.
Can you say that a direct cost is related to the production of the business?
It is. All of them are.
For example, like the salaries of the employees.
Uh-huh.
Mm-hmm.
I'd actually look at that more as an overhead expense. What is ChatGPT and Google saying about direct costs? Yes? Uh-huh.
Funds that you use to either produce whatever good product is selling.
Okay. I see. Does everyone agree with that? You can hear a pin drop. Okay. So you're 100% right. All that I would add to it is direct costs are costs that you can directly associate to, for instance, if we look at this table, the purchase of wood, we know directly where it's going to go into. Does that make sense? Let's see if they define it here on this next slide. Okay, no, they don't define it. Okay, so yes, it's often associated with your production of a good or a service, but you can directly identify the cost, all right, and what it's associated to. Indirect costs are, for instance, when we buy stationery, right? We're going to use stationery to obviously fill out your registration forms, right? To also for lecturers to obviously put together maybe some test revision documentation for you guys. So we can't say this cost is solely for registration purposes, right? Or solely for lecturing, facilitating lecturing and learning, okay? It's an indirect cost. Also, if you look at it from a manufacturing standpoint, if we are in the business of carpentry, right? We use glue for multiple reasons. We use glue to put together our chairs, our desks, and whatever other furniture. So we can't say, okay, this expense is solely for the purposes of this, that, and that. Does that make sense? All right. And then overhead expenses. These are expenses which are not within the production, or within the, let me say, associated to our output. All right, because indirect and direct, if we don't produce anything, we won't have any direct or indirect costs. All right, but with overhead, we are going to have water and electricity regardless of whether we make a sale or not. Does that make sense? So those are overhead expenses. Okay, and then if we wanted to further define them, some of those are fixed. They could be variable, they could be semi-variable, okay? An example of semi-variable costs, you're talking about the telephone bill, where we say, okay, a lot of us don't use landlines these days, but you'll find that with landlines, you pay a fixed amount every month just to have that actual connection for your landline. Then, depending on how many calls you actually make on your landline, you're obviously going to pay. by way of a certain rate and how much minutes you spend on your calls in total. Does that make sense? So that's what we mean when we say semi-variable. Yes.
But isn't it like all these courses? Isn't it similar to some extent?
Yes, it is. That's why we call it
Or semi?
semi, because there's also a fixed portion, and that fixed portion is the 200 rand I pay every month. You see what I mean? So that's why we call it semi-variable. Okay. All right, and then variable cost per unit. This is dependent on output. The more units we produce, the higher our variable costs. If we don't produce any units or products, we're obviously not going to have any variable costs per unit at least. And then obviously we got our total costs. That's when we add all our costs together. So that will obviously be made up of your variable and your fixed costs. Okay. So here now, I wish I hadn't actually started with the total cost. Okay. Graphic representation. Oh, this is total fixed cost. Okay. So there you can see, here they're basically telling us that fixed costs are constant regardless of the quantity. Can you see that? So whether we produce a unit of our products or not, whether we sell our services or not, our fixed costs, our water and electricity, it's going to be what it is. Does that make sense? Okay. Then here they're talking to your fixed cost per unit. And basically when they're talking about your fixed cost per unit, we are only talking about the more units. As you can see, this line is decreasing as we go further down. And this is important because they could very well just give you a graph and then say explain the key concept being addressed in the graph. Does that make sense? So here we've got our fixed cost at the very beginning of the line, right? And it's high. You can see that, right? And all they're trying to highlight is because we haven't produced any units, our fixed cost per unit is going to be high. Okay? As we begin to produce more and more units, can you see our fixed cost per unit is decreasing? Because we're spreading the cost, let's say 10,000, between more units that we have produced and sold. Does that make sense? So if we produce very few units, then obviously our fixed cost is going to be very high. The more we produce, the more we spread that cost across multiple units. Okay, and that's why that line is decreasing. Okay, right. Then here we're talking about variable costs, and there you can see graphically it's a linear line. Okay, I'm sure I'm giving some of you guys flashbacks of maths. That sounds wonderful, right? So here you can see what's happening with that line. As we progress to making more and more units, what's happening with that line? It's increasing. So what is increasing as if we interpret it using the graph? What does it mean? What's happening with our costs? Yes?
Our costs increase according to the output we produce.
100%. Okay? So that's how you will interpret this. You'd be saying the graph is displaying that our costs increase, our variable costs increase as we produce more units. Okay? So our variable costs are influenced by the volume of units we produce. Okay? 100%. So if we don't produce anything, no variable costs. Okay. And then here they're showing us what? Variable costs per unit. Can you see? This is actually constant. If it costs us 5 rand to make, no, that's bad. I was about to say, if it costs us 5 rand to make a chappie, there's no way they're selling chappies for 5 rand, eh? Or it's costing them to make that either. So let's say what? A big pen. If it costs us 5 rand to produce one big pen, just because we made 10,000 of them, is that going to change the cost of manufacturing one big pen? It doesn't. Ne? Okay. Right. So that's what they're highlighting over there. Okay. Now total cost. It's now this line that we have. Let's see, will it allow me to write? Okay, no, it won't. Okay. So total cost is now that horizontal line. And here what they're trying to illustrate is your total costs are made up of both your fixed and variable costs added together. That's what they're trying to do. Okay. Right. So maybe they might even give you the graph and want you to label the respective costs. Okay. Right. So now here they're now telling us about profit, and what we know about profit is the favorable difference that you get after minusing your revenue from your expenses. Okay. And we know that we don't always make a profit. Sometimes we might actually make a loss. When we make a loss, when our costs obviously exceed our income, isn't it? Okay, so again, there's nothing really new that they're sharing there. Okay, and then now they go on to talk about the statement of financial performance. Okay, we know it as your profit and loss and other comprehensive income. Okay, and we know that that's where we're measuring, did we make a profit or a loss? And we know that that statement is, it gauges, how did we perform? Did we do well? Did we do poorly? Right? So that is all that they're really bringing to our attention there. Right. So here, we're looking at a breakdown of the flow of your income statement. Okay. So here we can see gross income, which is a result of sales, and this could be sales of services or sales of products. Then less your returns and any cash discounts, which gives you then your net sales. And then less your cost of goods sold. Okay. Then we have our gross profit. Then less our operating expenses or other expenses, depending on which format you're looking at. And then you've got your operating profit. Then they deduct their interest. Okay, and this is quite useful recap for some of you guys, those of you who are doing 1B. And then you've got your profit before tax, less your provisional tax. Then you have your net profit after tax, less shareholder dividends, if any. Then you've got your profit attributed to ordinary shareholders. In other words, profit that shareholders are now entitled to. But doesn't mean you're going to pay all of that out. So they say here less dividends to ordinary shareholders. So how much we are actually going to pay out to them. And then here, this is the retained earnings, or what did we call it earlier this morning? Replacement reserve. Okay? All right. So the one thing that I wanted to ask here is, which income statement are they talking to? Are they talking to the periodic, or are they talking to the perpetual? Which one? Periodic. How do you know it's the periodic?
There's no cost of sales.
There is cost of sales there. How do we know it's a periodic? You guys are actually right, it is a periodic. So, how did you establish that it's a periodic? Can you see the breakdown of your cost of sales? If we were on the perpetual, we would have just said cost of sales. Because remember, we always know the value of our cost of sales, so we don't need to add up the respective line items. Does that make sense? But here you can see they've done that in bullet point 4. So that is why it is the periodic periodic system. Then here now they're just talking the objective of financial management. Okay. The long-term objective is to increase value. As financial managers, if you when you no, you guys won't do finance 2A. But if you are going to do finance 2A, the way they word it is that your objective as a financial manager is to maximize shareholder wealth. All right? Or in other words, to maximize your profits. Okay? Right? Your bottom line. This can be accomplished by investing in assets that will add value to the business. Okay? Keeping the cost of capital as low as possible. Okay? If we get financing externally from Nedbank, FNB, etc., they obviously want interest. Okay? And whoever we do get financing from, we obviously want to get it from the cheapest financer, because obviously that reduces the interest that we have to pay, which means that we have more money or value that we are generating within the business. Okay? Here they say short-term finance objectives should be to ensure the profitability, liquidity, and solvency of the business. Okay, right, and those terms we will chop up before we get to the end of financial management. Okay, but we obviously won't do that today necessarily. Okay. Then here they're now just talking to the fundamental principles of financial management. Risk and return. Is it possible for me to get a return without taking on any risk? Highly unlikely. Okay, unless you are putting somewhere. Okay, but typically, from a business perspective, we have to take on risk in order to get a return. And one of the fundamental principles in this regard is also the more risk that we take on, the more likely we're going to make a bigger return. All right? We often say in life, no risk, no reward, isn't it? Some of you have risked being elsewhere right now. Right? You could be anywhere, literally. All right? But you've chosen to take the time to obviously study. You might not get this qualification. All right? But you're taking on that risk because you know that the reward of having higher tertiary education is more beneficial than not having it. Okay? There might not be the type of return that we hope for. We might not all be CEOs or heads of companies, but at the end of the day, if we don't take on that risk, we will never know, right? Okay? Right. Okay, so then the next thing they're obviously just speaking to is cost benefit. And here, when it comes to financial management, all we're basically saying is, with every financial decision, we have to weigh. Us investing in this product, it means that we are foregoing, potentially applying the funds somewhere. Does that make sense? And what will help us establish where we invest the money is the cost-benefit relationship. Where are we going to yield the greatest benefit? Okay? And there is where we will then apply the funds. Okay? Right. That's all they're really speaking today. And then time value of money. This one, I think we'll delve into it more in our later sessions. But it basically is just highlighting the fact that when it comes to the value of money today is not the same as the value of money 2 weeks from now. Okay? Right. But I think before we go on, let's take our 10-minute break. And then we will proceed. We'll proceed at 2.
That's not very good. That's not very mindful.